Seeds of Wisdom RV and Economics Updates Tuesday morning, October 14, 25. Listen to the full version on the official dinarreport.com website and become our supporter on Patreon. Good morning. Dinar recaps the hidden cost of a shutdown. When politics freezes the U.S. economy as Washington's government shutdown drags on, economic ripples are spreading, not just domestically, but across global markets and confidence in U.S. leadership. Economic data goes dark. The U.S. government shutdown entered its 13th day, and Treasury Secretary Scott Bessent warned the closure is beginning to harm the real economy. With the shutdown, key agencies like the Bureau of Labor Statistics, Commerce Department, and Census Bureau have suspended their operations, halting release of critical economic indicators. A Reuters analysis also flagged that a shutdown could affect financial markets by limiting regulator operations and delaying publication of key economic data, thereby reducing visibility for investors and central banks. Ripples of confidence and credibility. The IRS announced over 34,000 employees, approximately equals 46% of its workforce, would be furloughed during the shutdown, hampering tax operations and citizen services. Markets reacted with nervousness. U.S. index futures slid amid concerns the U.S. shutdown would cloud the Fed's next rate path by suppressing data flows. Fitch Ratings, however, maintained that in the near term, the shutdown is unlikely to affect sovereign ratings, while acknowledging uncertainty and institutional strain. Global context. The governance gap as U.S. paralysis deepens, observers in emerging and developing economies see a reinforcement of arguments for diversified global governance, where dependence on Washington stability is too risky. Political dysfunction in the U.S. is being interpreted in some financial circles as evidence that the era of unquestioned fiscal leadership is waning. Why this matters? This isn't merely a budget fight, it's a test of U.S. institutional resilience. The longer critical functions remain offline, the louder the signal to the rest of the world. Monetary and structural dependency on the U.S. is a strategic vulnerability. Gold's comeback. The silent vote against dollar dominance as BRICS nations push alternative financial paradigms. Global players are rediscovering gold as a neutral anchor in turbulent times. Gold's strategic resurgence. Central banks are on pace to buy 1,000+ metric tons of gold in 2025, their fourth consecutive year of heavy accumulation. Global gold demand rose 3% in Q2 2025 to approximately 1,248.8 metric tons, driven by a 78% surge in investment demand, according to the World Gold Council. In parallel, physical gold ETFs hit record inflows in the first half of 2025, reinforcing investor appetite for safe haven exposure. De-dollarization and hedge demand. With the dollar's global reserve share slipping, gold becomes a logical diversification asset, especially for nations and institutions seeking refuge from currency volatility or political interference. Reuters noted that gold hit a fresh record, over $4,000 per oz, amid mounting U.S.-China trade tensions and expectations of Fed rate cuts. Another Reuters piece emphasized that anxieties over global geopolitical and economic risks are the biggest drivers pushing gold's 54% surge. This year, market narrative and forecasts. Bank of America has raised its gold forecast to $5,000 per oz by 2026, citing persistent demand as a hedge. Reuters framed gold now as the hedge everything trade. It thrives when investors fret over inflation, economic slowdowns, or geopolitical risk. Why this matters? Gold's ascent is more than a cyclic rebound, it's a structural recalibration. Each ton acquired, each ETF inflow, each central bank purchase is a tacit vote against over-reliance on the dollar. While the U.S. remains a central pillar, its dominance is being tested not just by alternatives, but by assets that transcend them. China's export boom defies tariffs. Beijing rewires global trade beyond Washington's reach. September data shows China's export machine remains strong despite 100% U.S. tariffs, signaling a rapid pivot toward new markets and the rise of a multipolar trade network. Resilient trade in a fractured world. China's exports rose 8.3% year-on-year in September, beating forecasts and marking the fastest growth since March. Imports also jumped 7.4%, reflecting both restocking and improving demand from developing markets. Analysts note that Beijing's export diversification is offsetting tariff pain. As the U.S. share of China's trade continues to decline, China is adapting faster than expected, said Xu Tianchen of the Economist Intelligence Unit. 100% tariffs will bite, but the effect won't mirror the shock of 2018. Tariffs as a political lever and a catalyst for diversification. President Donald Trump's 100% tariffs on Chinese goods, announced last week, revived fears of another trade war. Beijing retaliated by tightening export controls on rare earth elements and enhancing oversight of semiconductor users. Exports to ASEAN, Africa, and Latin America rose sharply, while shipments to the U.S. fell to under 10% of total exports, a historic low. This marks a decisive stage in Beijing's de-dollarization and South-South trade realignment, the architecture of a new multipolar economy taking shape. Markets adjust to the split supply chain. Shipments to India and Southeast Asia hit record highs, showing that regional integration is accelerating even as global supply chains fragment. Meanwhile, South Korea's export data reflected muted demand from China, underscoring Beijing's continued domestic challenges. China's trade surplus narrowed to $90.45 billion, down from $102.3 billion in August, a reflection of rising import appetite and global rebalancing. The numbers show not isolation, but substitution, the creation of new trade corridors that weaken U.S. leverage and strengthen regional interdependence. He wrote ahead, tariff truce and global realignment. The 90-day tariff truce between Beijing and Washington expires November 9. Economists warn that without a new framework, both sides risk renewed uncertainty heading into 2025. Beijing's policy push, including a 500 million yuan infrastructure credit program, aims to sustain export-led growth through the turbulence. China's ability to adapt under pressure shows that the global trade map is no longer dictated from Washington, but negotiated through multipolar alliances. Why this matters? China's export resilience, despite aggressive tariffs, signals a deeper transformation in how global trade functions. The U.S. can no longer rely on tariff leverage alone. The world is rebalancing supply chains and currencies at once. In this multipolar era, trade resilience equals geopolitical power. Listen to the full version on the official dinarreport.com website and become our supporter on Patreon. Source: Dinar Recaps.